Well, good morning and welcome back to the Broadcast Retirement Network's BRN Sunday podcast. I'm Jeff Snyder, your host and the lead anchor for the Broadcast Retirement Network. So glad you could join us today. We've got another great show for you again this week. We've got members of the media, academia, and financial services all queued up and ready to discuss the latest issues around retirement markets, technology, personal finance, and so much more. So sit back, relax, and enjoy this awesome episode of the BRN Sunday podcast. Let's kick things off with a look at technology. And joining us on the line from West Palm Beach, Florida, Dan Klein, Senior Technology Consumer Products Reporter with The Motley Fool. Hi, Dan.
Yeah, this is an unprecedented streak of me actually being home when I'm doing the show.
I know it's hard. It is hard to believe. Good for you. Good for you. I'm sure your wife and son appreciate it, and I'm sure you appreciate it because it's a beautiful day in Florida.
I don't know. We had temperatures in the 50s this week, and people were freaking out like it was negative 20.
Right. So everyone went out and bought went to REI and bought like parkas. I mean, what do people? How do people freak out? They just buy more clothes.
I think they have the clothes and they're eager to wear them. So we've talked about this before, but you'll literally see someone in like a bikini bottom and a fur coat, or
I'm trying to imagine
shorts and a sweater, or a scarf, but a tank top. Like just very strange. And yeah, for my son who gets on the bus at 6:30 in the morning, it was cold. It's still dark out.
Yeah.
But for a normal person who's like walking into Starbucks at 8:30, it was like 52 degrees. Like 52 degrees in the Northeast is like go outside in your shorts and throw a football around. So I think here there's just no understanding. Native Floridians simply don't know what cold is. And obviously that's different the farther north you go. In Central Florida, it does sometimes get actually cold.
Yeah, well, you are a transplant, so you have that knowledge of what it's like in the Northeast. But I will say that you guys are in a very good space. So Dan, let's talk a little tech, and I know there's a couple stories you want to talk about. One about banning cashless stores in New York, and this one just boggles the mind when you sent it over to me. So fill me in on this. Fill us in.
This is a tough one because we all know that Amazon has pioneered a store where you go in, it records what you're purchasing, it charges your Amazon account, you never take out cash, credit card, anything. And that's very convenient for people who have that technology. But one of the pushbacks has been, well, what if you just have your wallet? You left your phone at home, or you don't have an Amazon account, or you don't have a credit card, which is possible for some people.
Yeah. Mm-hmm.
How do you shop at that store, and is it fair? And I always sort of go back to the idea, when you walk into a store and they say, we don't take $100 bills.
Mm-hmm. Mm-hmm.
I always want to be the jerk who challenges that, because how do you not accept legal tender? It's money. I understand that there's a counterfeit issue with $100 bills, but I'm not making my own $100 bills. I've only figured out how to make smaller bills. That's a joke if the government is listening.
They are.
So I do think there should be a non-shaming way where stores can take cash, because some people are just more comfortable with cash. I mean, look, I live in Florida. It is not that rare for me to be in line at Publix, the grocery chain that dominates Florida, and the person in front of me is paying with a check.
Yeah, that's annoying. That's annoying.
In my head, I always am thinking, like, how about when I go to pay, I try to barter. I'll be like, I'd like these groceries. I can give you 6 shiny beads and my daughter's hand in marriage. I don't have a daughter, so I can make that joke. Look, I think we have to balance progress with accessibility. And I think it's okay if there's like a coffee shop at the airport that's open 24/7 that only, because there are in San Francisco now, there is a 24/7 fully automated coffee shop that you can only order through its app and you can only pay through the app. I think that's fine. I think if the occasional Starbucks goes to purely digital, that's probably okay too, because those are in cities where there's another Starbucks a block and a half away. But if you start seeing big chunks of stores not accepting cash, I do think that freezes out a piece of the population, and that's probably not great for the retailers. So I don't know. I think we should be as accessible as possible. I'm not sure that requires government involvement, because we're talking a very small handful of stores right now, and the reality is if are in New York and can't shop at the Amazon Go store, walk a block over and shop at any of the 9 delis that are nearby. You'll probably be okay.
Yeah, it's interesting, I kind of break this apart into a couple of pieces. The first is, yeah, I mean, I think it is inconvenient, but I don't know. Do we have an idea? And you're the technology person. Do we have an idea of what percent of the population do not have access to a device? And I think if, even if we do, even if that is a growing, even if that is a group of people, is that declining? Because Dan, we've dealt with this issue in the retirement space in particular, and we've talked with the Legal Eagles on the show, that there has been a move for e-delivery. So we have talked about the lack of innovation going on in the retirement space and the financial services space. But one area is the ability to deliver things to you, Dan Klein, electronically, and that didn't exist until recently in the retirement space. So the question and the real issue around that was that the argument was that people didn't have access to devices.
So I think that argument is maybe more relevant in retirement because the oldest among us is more likely to have a more simple phone and not have access to a computer. But the vast majority of Americans have a smartphone.
Yeah.
I don't know the number off the top of my head, but it's in the 80s, if not the 90s, in terms of percentile. So, but just because you have an Apple phone or an Android phone doesn't mean you want to associate your credit card with it. I know certain people in my family are very hesitant to give out credit card information. I know people who would willingly use, say, Starbucks mobile order and pay, but aren't necessarily going to use mobile order and pay at a smaller store or a local store because you don't know how secure it is. So I do think you need to account for that. And then
Mm-hmm.
you also have to look at just sometimes you have cash. Like I was in Vegas a few weeks ago and had a really good trip at the casinos, and I came back with way more cash than I would normally have in my wallet. So it would make sense for me for a while to things I might normally pull a credit card out for to use cash or to just go to the bank and deposit it. But who wants to do that? Um, so I think we still need to be accessible as a society and we need to provide alternatives. And again, you have to balance the situation. If there is a reason like an airport where a person coming in at 3 in the morning is really going to appreciate that previously there was only vending machines and now there's this awesome robot barista who will make them a coffee, but they have to get the app. I think there's a convenience factor there.
Yeah.
On the other hand, on that same trip to Vegas, my colleague and I went to a robot bar and we paid 3 times what a drink would cost. And frankly, I don't usually pay for drinks in Vegas at all, but 3 times what a drink would cost. And a robot made my gin and tonic and spilled it.
Oh wow, that
And
must have been interesting.
well, it was funny because it was the glass was too small. So like I got like a wet glass that was like, who knows what spilled out, whether it was the gin or the tonic or how well it was all mixed. But it was hysterical to watch because if there's one drink any bartender can make, that's pretty much it. Like it's not a complicated, it has 2 ingredients and they're in the name of the drink.
Yeah.
So we're not fully there with technology. So I don't think we should be locking out customers who don't want to pay a certain way. There's also the issue of connectivity. I went to a sporting event a few months back, and my tickets were digital and they wouldn't save into the Apple wallet. So they're on my phone. I had to actually access the network or Wi Fi to bring them up. And it took me a long time in line to do it. Now, I did it while I was in line. So when I got to the front, I was able to scan my ticket. Other people just assumed it would work. So when they got to the front, it took them a while because I think the Wi Fi in the area was being overwhelmed. Now, in that case, you did not have the option of printing your ticket. You had to use a digital ticket, which basically meant that loading 11,000 or whatever it was people into this arena took way longer than it should have because technology failed us. And until something is rock solid, I think we have to assume technology will sometimes fail us.
Yeah, well, I agree, and I think that it's up to look. I don't know if we necessarily, to your earlier point several minutes ago about having government mandate, uh, or banning a particular type of business or type of practice. I think that that might be a bit extreme, and I think it's in the best interest of the company to try to attract as many consumers as possible and allow people to pay in different ways, and I think that makes the most sense. And I think you exclude a certain amount of population. And I got to think, Dan, that on the part of the business, they've calculated, they've built in. Okay, well, this percent of the population doesn't have credit cards. We're not going to serve them, or we're not going to. We're not that we're not going to serve them, but we're not going to cater to them, or we're not going to take those payments because it just creates more. We get robbed. There's a gazillion other reasons you can come up with,
I
right?
think there's also more the retailers can be doing. So we've talked about McDonald's and Restaurant of the Future, which is basically ordering via kiosk.
Yeah.
And a lot of people have walked into those McDonald's and just bypassed the kiosk. And one of the ways to stop that from happening is to do what Target does with its self checkout and just have a couple of people assigned to self checkout that will walk you through the process. So I think if you're going to go to a cashless store, it makes sense to have a clerk, a customer service person during, normal business hours, maybe not during all hours, who can say to the person, "Oh God, I know this is daunting. You want me to show you how it works?"
Yeah.
Or, "Hey, we don't take cash in the traditional way, but you can buy this $20 scannable card," or whatever the workaround is to take the payment. I can't tell you how many times I've gone someplace as a pretty technologically skilled guy and just been baffled by how things work. And I don't want to be uncomfortable. Like if I go into a restaurant and the name of the dish doesn't tell me what's in it, that's a mistake. I want to know what I'm getting. So if I walk in and there's a new system of ordering, someone should be there to talk me through it. And certainly if my mother or someone who's, from a different technological age, but is still pretty with it in terms of that stuff, there needs to be some hand holding.
Yeah, man. All good points around. I guess more to come on this, and this is just the challenges when you deal with a technologically advanced society. I guess the Romans didn't have to deal with this. Dan, let's shift gears. Maybe they did. I mean, they did build aqueducts, right? But let's shift gears and talk a little bit about voting. I think you wanted to talk about a story, and this is kind of in line with data, right? And voting, and there's at least one election or two elections that are going to have electronic voting machines.
Yeah, so we're not going to talk about the politics of voting. This is about the mechanics
Yeah.
of voting. And I live in Florida, a state that's really bad at voting. Like, we, if there's an election controversy, we've caused it. We don't know how to count. Our election technology is from like 1945. So I went like many Americans for the midterm elections, and I voted, and I did early voting, and my wife and I had to drive someplace 4 or 5 miles away, stand in line for like over an hour, and then when you get there, it's a 6-page ballot
Oh,
that's
yeah.
somewhat baffling. Like there's first of all, the important races are not necessarily in the prominent places. So like I'm sure who's running for dog catcher or county clerk or whatever is very, very important to them, but I don't care about that race. I didn't know the candidates. Maybe I voted in one or two minor elections because I had some sort of personal connection. Maybe I bumped into the candidate at the farmer's market and they seemed nice. But finding the major elections was hard. Figuring out what the procedure of how do I pick the person I want was kind of difficult. Even the check-in system where they have to scan your license and go, it's all daunting. And the technology part of me says, wait a minute, I can vote for American Idol at home. Why can't I vote the right way? So there is one county in Washington State that is allowing this. They're allowing digital computer-based voting.
Hmm.
And I'm not saying we want to get rid of traditional voting, but I do think it's very important that if we want voting to be accessible, and I don't think all political candidates want voting to be accessible, but most Americans probably do, that we need to figure out technology-based solutions. And that means fingerprint identification, retina scans, who knows what it is, scanning your passport into the computer. I don't know what those answers are, but it shouldn't be difficult to vote. It shouldn't be expensive for a municipality to do an election because they need to set up these archaic polling places. Candidates shouldn't have to spend money on busing people who can't get to the polls. The other thing is people say, well, just vote absentee ballot. Well, we saw in Florida that absentee ballots only get counted if an election is close.
Yeah.
And if I vote, I want my vote counted. I also don't trust any of how they handle absentee ballots. Again, I live in Florida. Um, so these things exist, and I understand the reticence to them that, oh my God, there can be fraud, but we trust all our money, pretty much all our data to technology. And you can't tell me that if the US government went to Microsoft, Google, and Apple and said, give us three competitive bids for building out a secure national voting system, that we wouldn't get something that was very, very good, that worked better than what we have now. So I don't see this happening on a widespread basis, but it is encouraging that at least in a state as, and I'm using the word progressive in a technology sense, not in a political sense.
Hmm.
All the tech companies, a lot of them are in the Seattle area. So Washington State is very ahead of the curve in terms of technology. It's encouraging to see a state that has that many technology workers start to advance this, because it's going to be New York and Washington State and California and Massachusetts, places that have hubs, maybe even like Austin, Texas, that have technology hubs that are going to lead this process forward.
Well, I mean, I definitely at the face, I think you're right. I think we need to be able to leverage technology, and there's no reason why we shouldn't. And we have great technology companies in this country, and we should be able um, to do that. One of the things that I grew up in Maryland, as you know, and there's an issue there with people coming, clearing the voter rolls, and it happens throughout the other states in the United States as well. It just seems like all that stuff should be able to be handled electronically. There's no reason why we can't purge the voter rolls and know who's going to vote. And we have this technology to read irises and fingers and whatnot. It just seems like that can be done. I think oftentimes the implementation, as we've discussed, is the hardest part of this.
Yeah, I mean, and we're bumping into a political process, and you could argue this on both sides of the aisle, that doesn't necessarily want everyone to vote. I mean, if I'm running for office, I hope the people that support me will go vote, and the people who don't like me, maybe there's a movie on that day that they want to watch, and or maybe young people like me, so I hope it rains because they'll go out in the rain and old people won't. But I do think most Americans want everyone to be able to vote. So the pressure for this isn't going to come from politicians. Politicians, again, both sides of the aisle, are likely very comfortable with knowing how things work. If voting from home becomes possible, you would likely see a much higher participation level in voting.
Yeah, I
um,
think what percentage of the population votes? I mean, we had what 120 million people vote last time, if I'm doing the math right. Right?
if
Is
I
that right?
remember correctly, it's like under 60%, and that was like in a very contested year.
Hmm.
But think about some things like, so I grew up in a small town, Swampscott, Massachusetts. It's 3 square miles. It's a tiny little place. And Swampscott has elected selectmen. And you might get in a year where there's a budget controversy, a high turnout. You might get, 80% of eligible voters. But if it was done digitally in a town that small where you absolutely know every person running for every minimal office, you'd probably get close to 100% voting because people feel comfortable with the issues. On, national elections, you'd get better participation. And some of that is, look, we went on not election day, and it took us probably 2 hours round trip to vote. 2 hours of my time is worth a fair amount of money, and it's not a great investment in a lot of states to go vote when you know your candidate's going to win or not going to win. So you want to make this as easy as possible, because for a democracy to work, you want as many voices to be heard as possible.
Well, there are 200. I'm just looking at numbers while we're chatting. Sorry, Dan. I am paying attention, but I'm multitasking. There's 231 million at the time of the 2016 election, 23.15 million eligible voters, and 46.9% didn't vote.
Yeah, which look, some people just don't care. They're not going to vote no matter what the situation is.
Yeah.
But some people fully planned to vote and got up that morning and their boss had thrown 2 meetings on their schedule. And look, there's a lot of things we could do to make voting easier. How about have elections tie in with holidays. We have the problem now that many of our polling places are schools. So on election day, randomly, my kid has no school. Part of the reason I voted early is because I had my son home on election day. And do I want to drag him to the polling place? Do I want to make him sit at home for 2 hours while my wife and I go vote? So there's a lot of things we can do, but technology should be part of that discussion. And look, it might not be for everyone. There might be a verification process that only certain people can pass. If you, this is a ridiculous example, but if you're going on a cruise and you take your photo beforehand and scan in your passport and do a few other things, you can generally bypass the line pretty quickly. Sometimes you get up to the system that reads your face and it doesn't recognize you, and you have to go through the traditional method. So it doesn't have to be foolproof. It just has to be good enough that there's no fraud and that a lot of people can use it.
Yeah. Well, Dan, always a pleasure. We really went long on this segment, but it was well worth it, and I think people will really pick up a lot, and that's the important part of this podcast. So, Dan, we'll see you on Tuesday, where we're talking more technology, a lot of good issues. I don't want to spoil that for the audience, but until then, enjoy your weekend, and we will talk with you soon.
Hey, vote for me.
Yeah, a vote for Dan is a vote for you. Talk to you soon, Dan. Bye. Welcome back, and now we're going to shift gears, talk a little markets. Joining me on the line from New York is the co-founder of Delphi Digital, Kevin Kelly. Hi, Kevin. How are you?
Doing great, Jeff. How about yourself?
I'm doing well. It's a little chilly here in the Northeast, as you're well aware of, but I'm hoping that spring is ahead sooner rather than later.
Yeah, you and me both.
Yeah, man, it's absolutely too cold.
Tired of the cold weather.
I'm tired of the cold, but in spring, it's spring forward, and then you lose an hour of time. So anyway. But that being said, a lot going on in the markets. I want to talk markets before we get into crypto. And I understand that there's a new virus, and that virus could potentially has led to some of the market volatility that we've been seeing over the last couple of days. So what do you have to say about all this, Kevin?
I mean, it's one of those things where obviously, don't want to make light of a situation like that. And it's certainly seems to be progressively getting a bit more severe. But, us as analysts, what we do is kind of look back and say, okay, is there any previous examples of, when something like this has happened, like an outbreak? SARS probably being the easiest example. And just seeing what markets did. And interestingly, when you look back in the really late 2002, but first half of 2003, you did see actually, interestingly, a spike in gold prices and a sell-off in the S&P. Now, part of that also was just because the S&P was coming off that dot-com bust and still kind of recovering, and companies were still trying to get their fundamental legs underneath them. But you certainly saw some market action. But then after that, I think it was kind of a knee-jerk reaction. People kind of continued to trade the trend, and so the S&P rose. You had gold that performed incredibly well throughout the early to late 2000s, and that trend continued. So you saw a little bit of market volatility in the interim, but long term, I mean, it didn't really break any trends.
Yeah, and I mean, I agree with you. We don't want to make a light of this, but it just seems to me that we have a new crisis every week that the market reacts to. We had we've talked about the Chinese and the American trade tariff agreements that were driving a lot of this. We had the political stuff. Does it ever end? I guess the answer is no, because if it ended, we'd all just be indexers, right? So we'd just be indexing. But I mean, it just seems like that it's a new thing every week that just drives this market.
No, that's exactly it. And sometimes you can kind of push the narrative beyond just, I guess, the downstream effects of what this could mean, right? So you've obviously seen already with kind of the Chinese New Year coming up, you've already seen people canceling some of their plans, potentially hitting consumer spending. You could make that argument, but I don't think the effect of it is going to be something that long-term fundamentally matters much for markets.
Yeah. Now, when we put that aside and we just look at, what the Federal Reserve and central banks are doing, I mean, all signs point that this is a lights-out economy. I know you were not on last week. Oliver was, and he kind of reported that the thesis that he was hearing is that from his show is that, long term, the economy just defies the odds. Is it your sense? Let me put you on the spot and just ask you that. Is it your sense that looking at fundamentals, looking at earnings, look at all the things we've had over the last 18 to 24 months, that this thing is still going?
Yeah, I mean, there's certainly an argument to be made there. I think, part of the argument, especially with, the market at all-time highs and continue to put in new all-time highs, you certainly have the argument that, the US, whether it's from an investor standpoint, across various asset classes or just the underlying economy itself, I mean, you have the argument that the US is basically the best house in the worst neighborhood right now. And I think the underlying strength of the consumers, I mean, that's certainly been driving a lot of that bullish narrative. But at the same time, if you look kind of underneath the hood, there are a lot of cracks, whether it's within the labor market or you're seeing obviously this kind of rising income inequality issue
Mm-hmm.
continue to get exacerbated. I think there's some of those that long term potentially are going to put a hamper on economic growth. But right now, if you're looking again, if you're an investor or you're trying to make a trade on the U.S. economy, certainly over the next 12 to 24 months, there isn't really anything immediately pressing that would signal a serious economic downturn is coming.
And we just had Davos take place, where I guess all the, I don't know, power brokers is the right word. I don't know how you define all these people, but all these people,
Financial elites.
the financial elites go to Davos, which is Switzerland, right? And they have all these
Mm-hmm.
conversations. And one of the big takeaways, Kevin, that I saw, at least, I was not there. I don't know if you were there or not. Maybe Delphi sent you, but sustainability, climate. That's you hear Larry Fink kind of weigh in from BlackRock on that. I mean, how does that kind of weigh in terms of your thinking about the economy, global economy, with the move now with climate change and how to prevent that, and where asset managers and activists, hedge fund managers activists are looking?
Mm-hmm. No, absolutely. No, unfortunately, it was not in Davos this week.
It's a shame.
But yeah, hopeful and optimistic that maybe next year Delphi will send me.
Yeah.
But yeah, I mean, talking about sustainability, you mentioned Larry Fink, definitely someone who seems to be kind of on the forefront of this trend. I don't want to say that there's ulterior motives here because, again, I think it takes people like him with his stature to really kind of put the wheels in motion for something to actually get done on the sustainability front. But if you actually look at some of the underlying data, I don't know the exact number, but I think it's somewhere north of 50% of all total ETF and mutual fund assets that are tied to ESG, which is environmental, social, and governance.
Mm-hmm.
Those are actually under the BlackRock name. So again, they're trying to brand themselves as environmentally friendly, and sure, there could be ulterior motives there, but I think even just having someone of his stature come out and try and lead this charge it's certainly not a negative. It certainly helps.
Yeah, and just to bring that up go a little bit further on that. I mean, and I want to set aside some time to talk crypto because a lot's going on in the crypto space too, and you had that dual hat. But let's just finish this thought up. In terms of ESG, I don't know if we're at a spot yet with that asset class or that type of investment where we have all the protocols in place to validate whether something is a good or bad investment. And the reason why I say that is because I keep reading that the European Union and other entities are trying to come up with some level of standards that you can perform due diligence on these types of investments. Like, it's not enough to say we're ESG, right? We're following these protocols. It means different things to different groups of people.
No, absolutely spot on. And during my time when I was at Bloomberg, I know that was actually a big focus for one of their data groups, was actually trying to create standards around that because, to your point, it's very, very unstructured in terms of not only what the standards are and what you look for, but also the way in which certain companies report various reference data and things like that. Some report or are a little bit more transparent in their disclosures around sustainability issues. Some aren't. You can look at industries like the oil industry, for example, which is probably everyone's scapegoat in terms of, an industry that probably comes under scrutiny or potentially could perform poorly if there's heightened focus on ESG. But it does certainly seem like that is a growing trend, and it's more almost like a secular trend because I think, as you have some of these younger generations that are really, obviously environmentally conscious, going to be actually investing and looking to invest in companies that not only can make money, but can also actually make a difference.
Yeah. Well, I certainly think it's more than just a trend, and you're right. I just don't limit it to just younger people. I consider myself young, by the way, but I think that a lot of people won't
I do
have
too.
Well, you consider me young? I consider you young.
No, I consider you young.
Oh, thank you.
You're a young buck.
That is beautiful. But I think it is something that people are interested in, kind of maintaining the viability of their environment and their society. And I think there's definitely something to that. So that was a great half segment. So now let's turn our attention to cryptocurrency, blockchain. What's going on there? Because I just read someone else is pulling out of the Libra coalition, whatever you want to call it.
Yes, Vodafone.
Vodafone's out.
Yeah, so part of that, the Vodafone move is because they actually have an investment or a I don't think it's a subsidiary. I think it's just an investment. But anyway, they're working with a company that is focused on increasing the financial inclusion and payment streaming in Africa. And so I think they just want to dedicate a lot more of their efforts there. You have seen some other larger companies, especially the payment processors like Visa and MasterCard, pull out late last year, citing regulatory concerns. So you still have progress on the Libra front, but at the same time, it's I think it's going to continue to run into some of these kind of regulatory hurdles. But so far, it sounds like the company and the executives within the firm are actually trying to work with regulators to figure out the best way to push this forward. But that being said, I mean, a part of the focus actually in Davos this week that got some center stage attention was this idea of central bank digital currencies, like we've talked about. And you now have earlier this week it was announced World Economic Forum actually kind of came out with this toolkit for central banks interested in looking into issuing their own digital currency. You had a number of the major central banks, the Bank of England, ECB, Bank of Japan, actually forming some type of kind of mild consortium to start to put money behind research and development of exploring the potential of central bank digital currencies. So I definitely think that is a trend that, as we've talked about for a while now, is certainly in motion, and don't see it reversing anytime soon. I think just the way in which, obviously the economy is moving to be much more digitized, I think currency is going to move that way too.
Yeah, so two thoughts there. One, the defection of Vodafone. I agree. I mean, I think when you're building this asset class, and essentially what we're doing here, what the market's doing, you're going to have people try to pursue different avenues and different venues. So there's not that stickiness or that cohesion that exists within the market. That's number one. And then number two, I think the fact that central banks are exploring digital currencies shows me that the market's taking this very seriously.
Yeah, no, I mean, absolutely. And I think it should. I think it's certainly something that will represent, a bit of a paradigm shift if you think about the way in which the current financial system is organized and structured. And the opportunities and even growth opportunities that a digital, more efficient currency can offer, certainly is something to be taken seriously. And I think the market agrees. It's just a matter of understanding, and this is something that we preach, just growing the awareness and understanding of the difference between something like a central bank digital currency, which at the end of the day is still backed by the same thing that any fiat currency or cash out there is, versus something like a truly, what we would consider a truly non-sovereign digital asset that's censorship resistant, which is obviously Bitcoin, like we've talked about for a while. So there is a pretty fine line to draw between the two, but I don't think we're going to live in a world, even 20 years from now, where you don't have some degree of fiat currencies, even if Bitcoin becomes a much larger kind of centerpiece, whether it's a alternative digital reserve asset or just a worldwide kind of global medium of exchange to some degree. I don't think you're ever going to do away with fiat currencies. I think the two don't have to be mutually exclusive.
Yeah, and I've also read where there's a survey of over 400 financial advisors, Kevin, I think by Bitwise Asset Management, that basically they are thinking about these financial advisors. And so we're talking about the market, right? And we're talking about institutional, which we've talked numerous times on the show, how they've embraced and how people are investing, and pension funds, endowments are investing in this. But now you have financial advisors, these 400 financial advisors saying, hey, we think we're going to allocate money or monies for our clients in, and it's gone up significantly. It was 6% in 2019. Now it's up to 13% in 2020. So clearly there's more adoption there. And when you get that, or more adoption in terms of thought process, and that's where you ultimately, it catalyzes itself into more of a market.
Yeah, it's interesting. I mean, I think, we've had this institutional argument for a while now, but to be honest, I wouldn't be surprised and starting to expect the next kind of wave of we'll call it sophisticated capital to kind of come from that segment of the market, because you have somewhere north of 13,000 financial advisors that manage somewhere around 40 to 50 million dollar, or excuse me, 40 to 50 million separate accounts, right? So if you think about just the size, the trillions and trillions in assets that financial advisors and private wealth managers have, we've had numerous conversations with them that are actually starting to look at it again from a global macro perspective and say, we're starting to get a bit worried about whether it's the dollar's reserve currency status long term, or just the rising risk again of broad-based currency debasement. In a world like that, and if you can get past the argument for allocating to something like gold, having Bitcoin be kind of the high beta play on that and having a small allocation there makes a lot of sense, not only from a return perspective, but from a risk perspective as well.
Yeah, and from what I can see, just based on my own knowledge of the financial market, and we're going to have to wrap it up within, I'll give you 30 seconds, is there's about $68 trillion that is expected to move between generations within the next 25 years. It's $68 trillion that is going to transfer from people retiring and leaving to their heirs. And where's that money going to go, Kevin? Is it going to just go in annuities? Is it going to go in cash? Is it going to go in Bitcoin?
I think it's I was going to say all of the above, and to various degrees too. And I don't think, the final point, I don't think it takes it just given how small this market is still, and given how small the market is for Bitcoin relative to other asset classes, I don't think it really takes a whole lot to move the needle, right? So even if you had 1, 2, 3% of that money move across asset classes into something like Bitcoin, I mean that's a substantial amount of value that Bitcoin would have to hold to support that.
Yeah, I bet you Delphi would love even a quarter of that. Kevin Kelly, always a pleasure talking with you. Enjoy your weekend, and we will talk to you very soon.
Thank you, sir. Appreciate it.
Bye. Welcome back. Now we're going to shift gears, talk a little real estate and personal finance. And joining me now is real estate and personal finance reporter from Dow Jones Market Watch, Mr. Jacob Passy. Hi, Jacob. How are you?
I'm doing well. Yourself?
I'm doing well. A little tongue-tied today, but I'm doing great. Thank you. So a lot going on, and a lot going on in your beat. So
yes.
What's top of mind this week?
Yeah, so this week, FICO announced that it's making some changes to its credit scoring models. They are introducing 2 new credit scores, and so I did a story basically, meaning, indicating what that means for folks. I feel like a lot of folks don't even realize that, there are different versions of the FICO score. When you sometimes hear people just, name drop, oh, my FICO score, my credit score. Mm-hmm. Well, actually, there's all sorts of credit scores. Everyone has more than one. FICO has different models that it uses, and then lenders can choose from among these different models. So did a story kind of laying all that out for folks.
Wow. And I think a lot of people, Jacob, and I want to get into some of the nuanced differences. I agree. People don't understand that there are different agencies that declare FICO scores, but also that most people who live in the various states have access to a free credit score, a free credit report, which they can get some of this information. Or if you bank with a major banker, you can get some of this information as well.
Yeah. But the trouble there is the information can vary, and that's where these different models come in. So, for my story, I talked to the folks over at Bankrate. One of the folks over there, Ted Rossman, great guy, great source for many of my stories, and he gave me a personal anecdote that he looked at. So all the different FICO models are numbered, so FICO 2, FICO 4, et cetera. So he looked at 3 different FICO scores, 1 from his mortgage lender and 2 from different credit card companies, and each one of those scores was different. And they varied by 37 points across them.
Wow.
So, that's a big deal. And I think, a lot of people don't, again, like I said before, people don't realize that, you technically actually have more than one credit score. And then, it depends on the model that's being used and the information that's going into the computation of it. From credit bureau to credit bureau, your credit score can vary because of the information they get. Sometimes lenders report, banks report more quickly to, for instance, maybe Equifax rather than union. So Equifax will get your, your latest loan payment information, and TransUnion won't. So your credit score might be, higher or lower at Equifax than it is at TransUnion. That all can happen. And so it's important to, it is important to keep this in mind as a consumer, but also, experts kind of said don't stress too much, because there's not too much you can do on, lenders, choose the model they're going to choose. And in some cases, they don't actually have a choice. So for instance, with mortgage lenders, Fannie Mae and Freddie Mac have certain requirements that they have to meet in terms of the credit scores they use. So they have to use credit scores from the three major credit bureaus, Equifax, TransUnion, and Experian. And and there's only one type of credit score they can pull from each of those bureaus. So and those are actually the older models. So some of the changes that FICO announced this week actually won't affect the credit score that your mortgage lender is seeing. So something to keep in mind. But going into what's changing, the new models. So the new models are called FICO Score 10 and FICO Score 10T. So FICO Score 10 and 10T. There's some changes that are the same across both. One of the big changes that I think affects a lot of folks right now is they're shifting how they weight personal loans in the algorithm that determines your credit score. So they're weighing personal loans more heavily, and the reason they're doing that, experts say, is because there are a lot of folks out here who are consolidating different forms of debt, medical debt, credit card debt, et cetera, into personal loans and then going on to rack up more debt. That's a great strategy, if you, consolidate into a personal loan and then, just pay that off and avoid, accruing more debt on a credit card or anything like that. But if you're basically are using it as a way to, just like shuffle the papers around, so to speak, it's not great. And so they kind of want to, since personal loans are now the fastest growing loan category, they clearly, wanted to take a look at that and make sure that they, were assessing that more correctly in their newest version. The
Jacob,
other big
well,
yeah.
Just a quick question. You had mentioned that these different models. Do you have the ability? And I'll let you get back. And I didn't mean to interrupt you, but I'll let you get back into a second.
Go for it.
But do you have the ability as a consumer to ask the question, what FICO score are you pulling, or what score are you pulling? Do you have that ability as a consumer?
I feel like you certainly can ask, and you certainly should ask. What is the credit score you're seeing for me? If it's a more extended loan application process that you're going through, just good to kind of keep that in mind. You should check your score ahead of time, before you're applying for any loan to get a sense of things. Just keep in mind that the score you see, if you use something like CreditWise from Capital One or something like that, may not be the exact same score that the lender's seeing, although it'll probably hopefully be around the same range. So you can definitely ask what they're using. For reference, the most commonly used model is the FICO 8, which was released back in 2009. And so that's interesting because the FICO 9, which came out in 2014, is used less often than the FICO 8. So that also kind of shows that lenders are slow to adapt. There's a lot of risk on the part of the lender when they start using a new credit scoring model because, it's not as tried and tested. They don't necessarily, they might have their own internal systems that they have to reconfigure for the new score, and it's the data that comes with it. So a lot of lenders are pretty slow to adapt. So that's also something to keep in mind is, the changes that FICO's announcing this week may not affect you for quite some time depending on what lender you go with.
Yeah, it sounds like it, but you need to be aware, it sounds like, based on the industry, what you're doing. So if you're taking a mortgage loan or you're taking a car loan or you're taking a personal loan or anything, you need to be aware of this. And I don't think a lot of people are, Jacob. And by the way, I interrupted you, so why don't you finish your thought on what was changing? So my apologies, but thanks for answering that.
No, don't apologize. It's your show. So the other big change is with the FICO Score 10T. So the FICO Score 10T is introducing trended data, and that sounds very fancy, but basically what that means is they're basically looking, beyond just looking at what's happened to you, they're looking at the trend of what's happened to you. So when it comes to your credit, so let's say you're 4 years, let's say it's 2 years worth of data. So let's say 2 years ago, you missed missed a couple credit card payments, but have made on-time payments every time since then. It'll, kind of smooth things out for you. So it could benefit you and show that, the trend of your, credit history is positive. You had this bad event, a couple years ago, but you've been really diligent since then and, are smoothing things out. So that can benefit you. Flip side is, let's say, you used to be really on top of things and then now you've missed, 5 payments in a row or something like that, or your credit utilization ratio has just gone through the roof and you're, racking up tons of debt on a credit card and not really paying it off in full. That will also show, so that kind of will show to the lender, and factor into the score that, you're, becoming a bigger risk. While you had a really stellar credit for a really long time, now you're kind of falling by the wayside a bit. So the trended data is a big change, and that's something that lenders, I know this from my mortgage industry reporting and everything, that's something lenders have been wanting for a while because it provides a more kind of holistic view of the consumer, but, also kind of, and it can help you, but it can also hurt you.
And I've also had banks where I have a credit card or where I bank, they've asked me for an update on my compensation. So if your compensation changes, I understand that's, I like the fact, I got to tell you, I like the fact that it's not just a static model, that it's an evolving model, because I think it's important. We all go through different phases, and if you're lending me money, you probably want to know what my current behavior is, not what my previous behavior was.
Right. No, you definitely, and I think, and with that, that's the other thing to keep in mind is, no lender is making a decision just on your credit score alone. In most cases, they're looking at your income because they, for them, they can do their kind of calculations of your debt to income ratio. How much do you have in debt every month, and what is that relative to what you're taking in every month, to see kind of, if you lose your job or something like that, it gives a sense of, what you might have in reserves that could, continue paying off your debt. And that's, and the other thing that experts say is like, it is good to have good credit. And the helpful thing is, while the models change, generally speaking, the behaviors that lead to a high credit score are always the same. So, paying your debt off, on time, making on-time monthly payments, not taking out too many credit cards too fast. And then there were a few tips that I thought were interesting in terms of, how you can boost your score, since these changes might cause some people's score to go down, and that might be something they want to fix. So first was to reduce your credit utilization ratio. So that's, that comes up more with your credit cards. You have a credit card limit, and if you're spending to the top of your limit every month, that doesn't look favorable when it comes to this ratio. So what they suggest is, and that can be the case even if you're making, even if you pay off your balance in full each month, if you're running up the full balance of your credit card every month, that doesn't look great. So what experts suggest is making more than one payment a month, making a payment every 2 weeks, every week even. That'll keep your utilization ratio low and help you look good in the eyes of the credit reporting agencies. Correct it.
I was going to say, can you ever have too much credit? Like, if you say you underutilize, say you have $25,000, but you only use 10% of that every month. Can you ever have too much?
That's a good question. I actually don't know the answer to that. I think that they, what I would caution is, against opening up, too many credit cards and then closing them, because, one of the factors that they look at is, the age of your credit and the, average age, and you can get dinged when you close a credit line, because that lowers, the full amount of credit available to you. But I don't know if you could have too much credit available to you. I think, that might just, I think if your utilization ratio is low and you're paying what you are, spending on time and everything like that, I don't think it can hurt you too much, but I can't say for certain. That is an interesting question I'd never considered before.
Yeah, well, leave it to me to ask that question. Hey,
well, and it comes up with the folks that are churning credit cards and stuff like that.
I got to think that you can underutilize, but maybe that makes you a good candidate for borrowing. And then we talked at the top of the segment about getting an annual credit report and getting some of this information. But I know there's some other services. I happen to have Mint.com up, and I know there's like Experian and some other services that offer that information. So, like, for example, Mint, you can sign up on Mint or Personal Capital, one of these programs, which can help you save and budget, will give you that information from time to time and show things being updated. I think maybe the audience just needs to be aware that when you use those services, some of that information is being scraped and can be
Yes.
used for other purposes, though not necessarily nefarious purposes.
And I would caution people, you feel free to use those services if you like them, but I would also say it is important, at least once. So, like you were saying, you can get a copy of your credit report for free once a year from each of the 3 credit bureaus. So, what a lot of folks recommend, and what I would recommend is, staggering it. So every 4 months you get another one of your free credit reports from one of the credit bureaus, making sure it's a different one every time, so that way you're not. Because if you get more than one credit report from a credit bureau each year, you have to pay for it. But it's good to do that because it's good to make sure that, you should be looking at your official credit report from, Experian, Equifax, or TransUnion, because that will indicate if there's any fraudulent activity going on in your name, which you may not be aware of and a site like Mint might not capture. And it's also important to catch any errors on the part of the lender. Let's say they forgot to, let's say they accidentally said that you missed a payment when you actually had made that payment on time. It's good to get those things, fixed as quickly as possible once they arise. So that way, because that can really hurt your credit score. And, if you then go to apply to a loan, you don't want those nasty surprises. So it's good to keep kind of, a tab on these things. And I think, it's good to get it straight from the horse's mouth, go straight to the credit bureaus and get your credit reports from them. But, on an ongoing basis, these other services can be super useful. When it comes to repairing credit, you have to be careful with some of the credit repairing companies because a lot of them charge really high fees. A lot of them will do things without asking you, getting your approval to try and quote unquote repair your credit once you've signed up with them. Sometimes they require you to have their services for many years in the fine print. So be careful about that. There are a lot of steps you can take on your own to improve your credit score without having to resort to one of those agencies. But if you do spot fraudulent activity or something like that, it is good to consider hiring a lawyer or contacting the authorities, especially if it's fraudulent activity, because they might help resolve it more quickly for you and find out who did it.
Yeah, and unfortunately that seems to be the sign of the times. A lot of information out there, a lot of data breaches. People need to be prepared and checking things, and I think you make some really great points. Jacob, always a pleasure talking with you, and I'll just correct you on one thing. It's our podcast, not my podcast. It's all about you guys. Without you guys contributing and sharing really good information, it wouldn't be a great podcast. So until next week, we will talk to you again. Enjoy yourself and stay warm out there.
Yes, you too.
Thanks, bud. Bye-bye.
Take care.
Welcome back, and now we're going to shift gears and talk a little bit more about retirement, of course, because that's what the show's about. And joining me on the line, he is just one half of the Legal Eagles, better known as the Retirement Rock Stars, and he's been on the road all week, I believe. Mr. David Levine, a principal with the employee benefits law firm Groom Law. Hi, David. How are you?
I am good, Jeff. I am on a train. After planes, trains, and automobiles, I'm at the end of my road.
Oh, I know. It's Friday, and you're on your way home, and it's probably been a long week for you. So let's just jump right into it because it's been a long week. So what's top of mind for you and the Eagles as you're thinking about retirement?
Well, as a lone Eagle this week, I think for me, the top of mind for me is very, very simple. It's all right. So we've been talking to you about Secure. What comes next? I'm not going to talk about more legislation because I'm guessing by now the listeners are sick and tired of that. And I don't have my friend Mr. Walsh here to actually to critique and challenge me. So instead, I think this week, let's talk about two quick things. What are priorities for guidance?
Yep.
Well, let's talk about the IRS really fast. The age 70 and a half to age 72 required minimum distribution thing, boy, it's wonky, but there are some real things to discuss. Put really simply, people who quit now who don't have to take RMDs, people are still having to figure out how do we get our systems updated so people can roll over the money to an IRA and not get tax withholding. People are figuring that out, and I'm hopeful that the Treasury Department will be figuring that part out soon. Similarly, there's also the idea about stretching things out, and that's a big deal. So we should really think about that. And I know Mr. Walsh is now on the line, but I'm going to let Mr. Walsh talk about what we might see from DOL. What do you think we're going to see on MEPS from the DOL in terms of guidance, Kevin? David, I think that's a great question. And DOL was asked to issue guidance with respect to MEPs, and really the focus is kind of on the administrative services that a MEP provider has to perform. And to me, I think we can expect to see some guidance on that at some point. And that's going to be really interesting because if they define the services that are administrative that a MEP provider has to provide so very broadly, that could disincentivize players from entering the PEP space, which really could lead to a coverage gap continuing for small employers. The other area where I think we could see some guidance is with respect to, a PEP provider and their ability to play a role in defining kind of the world of investment options that are available inside their PEP. And some of this just comes down to the idea that, when you launch a PEP, as a PEP provider, I think we expect it'll be mainly financial institutions and record keepers and advisors who launch these new plans. And frequently, if you're a record keeper, you've had kind of a platform of investment options that have been available that plans can choose between. And so like a record keeper may think, I already have a platform. Why don't I use this when I serve as a PEP provider to a PEP? And in some cases, these products have proprietary products in the lineup. So where you have a PEP and it's including, and a PEP provider wants to include proprietary products, we may see DOL get involved in providing guidance in that area. David, what are your thoughts on this?
Kevin, aside from being on a train, I happen to agree with you. I think it's going to be an interesting discussion because it was part of the tension that was something that was going back and forth. I think that even though secure passed, there's a lot of back and forth we'll have to see. But on that note, we're going to pull into a station soon, so I'm going to turn it back to Jeff to close us out.
Yeah, thanks, guys. And just for the benefit of the listeners, I mean, these regulatory things that have to be worked through, I mean, this is all normal process that comes as a result of the passage of legislation, right, Kevin?
Yeah, this is normal for the passage of legislation. And one thing that is really worth mentioning here is that for PEP providers who launch a product or who create a PEP before guidance comes out, so at the beginning of next year, assuming guidance isn't finalized, the end of the provision has kind of a safe harbor that says, if you made good faith efforts to comply with the text of the statute, and then the regulation comes out and requires something different, then at least on a look-back basis, your best efforts were sufficient for the period prior to the regulation. But yeah, this is typical. We see regulations come out based on statutes. Basically, every regulation is based on a statute.
Yeah, and then anything you want to add on missing participants, Kevin? Because I know that is your bread and butter. One of your
bread and butter. I just think with PEPs that
Jeff, did you have to go there? Jeff, did you have to go there, Jeff? Really?
Look, I love the guy.
So much to talk about on PEPs.
So I think PEPs, if we think about outsourcing administration, that it might provide economies of scale that might make it easier to facilitate looking for participants. Or if you're a plan sponsor and you're dealing with a missing participant investigation, or you've dealt with this in the past, it might make joining a PEP more attractive.
Kevin,
because you can outsource a lot of that.
Kevin, we're done. They're going to sing the chime for the door of the train in a moment here, and I think that's your bell too. So why don't we talk about PEPs more next week?
Awesome. Well, guys, thank you so much. Appreciate you making some time after a busy travel week. PEPs, MEPs, and automobiles and trains. David Levine, Kevin Walsh, they are both retirement rock stars and the Legal Eagles. Have a great weekend, and we will talk with you soon, gentlemen.
Oh, thanks, Jeff. Have a great weekend.
You too.
Bye.
Well, that wraps up this episode of the BRN Sunday podcast. Hope you found it educational and entertaining at the same time. And don't forget, we're back again tomorrow morning. That's Monday for another great episode of BRN AM. You can check it out. So until next week, I'm Jeff Snyder. Keep on saving, and don't forget, roll with the changes.